Hello Sector Watchers, welcome to the show. This is the 165th episode of Sector Spotlight for Tuesday the 28th of February, and I'm recording this on Monday the 27th, as usual after the close of the US markets. My name is Julius Kempenaer and I am presenting to you from Amsterdam in the Netherlands. In the next 30 or so minutes we will be looking at the current state of sector rotation and highlight the ongoing rotation out of defense in favor of more offensive and economical sensitive sectors. As it is the last Tuesday of the month, a big part of the show will be dedicated to the segment on seasonality. We'll take a look at the seasonal pattern for the S&P itself and then zoom in on a few sectors that historically have strong or very weak seasonal tendencies and see whether we can align that with current rotations. Ladies and gentlemen, please enjoy this week's episode of Sector Spotlight. I am going to start the assessment of current rotation with the sectors and the asset class rotation. I will talk a little bit about that in a later phase where we talk about seasonality. Also, I'm not going to talk about all the sectors because, again, in the seasonality segment, we're talking about 4 sectors that are worth looking at. The main takeaway from the current rotation on the relative rotation graphs as we see them right now, I think are twofold. The first one is the point that I've been trying to make a couple of weeks already, I guess, is that market is still moving out of defense. Look at utilities, staples and healthcare. The 3 sectors inside the lagging quadrant. 2 of them are actually crossing over this week because this was last Friday and this is based on Monday's price action, but the direction of those tails is very clear, are pointing to a market that is moving out of defense. Now, where is it going? It already went to all the stuff that's in yellow, so financials, materials, industrials, energy. Right now, the tails that have positive headings are technology and consumer discretionary, and to a lesser extent, communication services. Talked about communication services already a few times, but you can see that technology, again, this is based on today's price action, is moving into the leading quadrant, underscoring the current strength, and the same thing goes for consumer discretionary. Now, if we bring all that together, then I think we can still quite safely say that the market is moving out of defense. Whether it is a new, fully fledged bull market, not yet, but we're getting more and more signs, despite some weak days, and maybe even a weak week, as we saw last week and the week before. So the bigger picture here, as far as I can see from the RRGs, is a market moving out of defensive sectors, which is usually happening when the market's going into a new bull market or into a bullish phase. And sectors like consumer discretionary and technology, which are 2 heavyweights, are picking up. All of that under the hood is not necessarily a bearish sign. Now, going through a few of the individual sectors, here is technology. As I said, breaking out of that falling trend channel, taking out the previous high, that is a bullish sign. That is a good chart. That is a chart that is moving, is in transition, moving from a downtrend into a possible new uptrend. Consumer discretionary, we'll talk about a little bit more when we talk about seasonality, but again, it's not a really bad chart. And then communication services is the one that I missed. That's the one that we have right here. That's already a good chart and is going through its first pullback. Support probably somewhere around 52. Now the other ones, that's the weak stuff. Those are the defensives. It's utilities. We'll talk about that in seasonality as well, but you can see what's happening here in terms of relative and price. Here is healthcare again. Tail moving inside into the lagging quadrant, testing resistance and now dropping below support on the way to the lower part of that trading range. Trend line and relative strength broken, RRG lines below 100. Consumer staples, that's the one that we're not going to talk about in the seasonality segment. But again, it's a defensive sector, and you can see that we've completed a double top against the upper boundary of a range in which we are for almost a year, I'd say. And that old support is now acting as resistance, and the market has trouble going higher. So there's quite a bit of downside for the consumer staples sector, especially if we take out that previous low, which is around 71.50, 71.60. Now, another sector that is quite interesting right now is the energy sector. And on the RRG, you can see that that tail is inside weakening and sort of jiggling towards the lagging quadrant. If we look at the price chart, then you can see that this is one of the few sectors, maybe the only one, that is actually pushing against all-time high levels. It failed a couple of weeks ago, so this was the week of 23rd of January, and that previous peak was set in November, so we didn't quite get there. We didn't manage to pass through. But we're now holding at the in-between support level, which is a combination of a previous high and a previous low, and we're getting closer to that rising support line. Now, in an article for the newsletter last week, I went in depth into the energy sector, and I think what's happening there is an interesting shift in leadership. You can see that rotation here. You can see that starting to pick up. We still need to wait and see whether that's continuing, but there are two stocks inside energy, two really big stocks, the top two, that's Exxon and Chevron, so XOM and CVX. And if you look at those charts, then you see an interesting development, because here is CVX, and you can see that it looks a lot like the XLE chart, no surprise there, but this one broke below that intermediate support level between those two highs, essentially completing a double top formation. We're still holding above that rising support line, but the upside is limited, especially when you take into account the fact that we've broken below support on the relative strength line. So the price chart is weaker, but the relative chart is really weak. And that is because of that rotation into that lagging quadrant. And if you bring those two on, I put them on a RRG in that article, then you can see that CVX is actually right here, pushing into the lagging quadrant. And if you look at XOM on the RRG, it's right here, pushing into the leading quadrant. And look at that price chart, that structure, higher highs, higher lows, a break to new highs in relative strength, and RRG lines pushing higher. So whatever happens with XLE as a sector, I think that within that sector, there is a clear shift of leadership from one heavyweight to another in favor of ExxonMobil at the time. What does seasonality tell us for the coming month of March? If we look at the table, then I've put a border around the month of March, and you can see that there are a lot of 50s, around 50, 55, 45, so there's no real outspoken moves here, which is a bit of a pity when you want to look at seasonals. There's a few, so real estate and utilities at 70 and 75%, that looks promising. And then we got healthcare at 40, prefer to see 35 or 40 on the downside. And then consumer discretionary is at 60. That's kind of in the, in the margin. 65, 70 would be better. But what's very interesting is that SPY itself, and mind you, this is the outright performance of SPY, and the other ones are all relative. So for stocks, for SPY, March is usually a very good month. And what's even more interesting is that it's going to be followed by a string of good months. So March, April, May, with a little dip in June, and then July is usually, we all know that, is a good period for the stock market. So let's keep that in the back of our minds. The other ones are all relative. And if we bring in the average performances for the sectors and for SPY, then we can see that in March, on average, over the last 20 years, SPY picked up 1.1%. Now, that means that, for example, real estate, which in 70% of the time outperformed the S&P 500 in the month of March, and the average performance was 2.6% over the last 20 years. If you translate that, with SPY itself going up 1.1%, an outperformance of 2.6 means that we are, or that based on seasonality, real estate should go up 3.7%, and utilities should go up 2.3%. Healthcare should, or is expected, to go up only 1%. It's underperformed, so minus 10 basis points decline below SPY means that healthcare still expected to go up 1% in the month of March. And consumer discretionary is expected to go up 1.4%. Of course, this is all very theoretical. This is all based on a model and on historical performance, but we're trying to bring all this into our equation. It's all pieces of the puzzle that we're trying to solve. So the main takeaway is that the month of March usually is very good for the stock market, 70% of the time. That's the most important thing to keep in our minds. We're going to look at that in a minute. And then pretty much materials, communications, energy, all the other sectors are kind of in the middle of the road. There's no real outperformance or underperformance. And then based on seasonality, real estate, utilities, and to a lesser extent consumer discretionary are expected to outperform the S&P 500, and healthcare is expected to underperform the S&P 500. Now let's take a look at the RRGs and the accompanying charts to see whether we can find anything that matches or does not match what we see in this table. What we have here is the relative rotation graph for asset classes, and I usually don't use this one for my seasonal outlook, but I thought that today it was a good choice because there's interesting rotation going on. If you look at the tail over the last 5 weeks, then you can see that the S&P 500 actually rotated strongly back up and is now moving towards the leading quadrant, which, as we know, is a strong sign. And the benchmark here is VBINX, which is basically 60% in stocks and 40% in bonds. And if we look at the bond components, which is government bonds, corporate bonds, and high yield, then you can see that they are all at a negative heading. But above all, look at the rotation for government bonds. This is like 1, 2, 3, last 3 weeks. You can see that rotation, so 3 weeks ago at the end of January, government bonds were still relatively pushing higher and at a strong heading, and SPY stocks were on the opposite heading. And look at what happened in the last few weeks. SPY snapped back up, government bonds rolled over, and it's now actually picking up, which is interesting because obviously last week wasn't the best week for the S&P 500. But if you look at the relative trends that are developing versus a balanced benchmark, then I think what's happening here is very interesting and in favor of SPY. This is actually pointing to a period of outperformance for SPY upcoming. So let's start, before we go to the sectors and the seasonal pattern for the sectors, let's start with a look at the S&P 500. And here is the weekly chart of SPY, and let me make this a little bit nicer. So I'm going to put the RRG on the right and then the SPY chart on the right, so we make better use of our screen real estate, as that's called. And remember, seasonality, 70% of the time, the month of March is a strong month for the S&P 500. Now here's the weekly chart, and we all know that downtrend, we all know the break that went and then the rally. So theoretically, technically, We're in a new period of higher highs and higher lows. And we came off that 418 high, and we're now, I think, at a pretty crucial juncture for the S&P 500. We are now testing that former resistance line as support. And there is and I've shaded it a little bit because it's working, but you can see that there is one and then, 1 to 3 weeks in a row that this line is tested. And then we had it 2 weeks, last week it was tested, and we're hovering above it right now. So there is quite a bit of support, former resistance, now support, and new support building up in the area around, let's say 390, 395. So I think that's as I said, a pretty crucial juncture, pretty crucial level for the S&P 500. If we're going to put in a new low here, it's going to be a higher low, the 1, 2, 3rd higher low, or if this is the low, then the 1st, 2nd higher low, no matter how you want to look at it. And that means that this is going to be the jumping board for a new rally, potentially targeting that 418 level. And if we can take that out, we're looking at 428, 430. So with that seasonal outlook, the support coming in, I am inclined to say that the corrective move that we have seen for the S&P 500 is going to find support at current levels, give or take a few points. The good news is that the market is not oversold nor overbought. So we're at around 50, well, as a matter of fact, 50.95, so you can't get any more in the middle for the RSI. And the MACD is still working its way higher off this long-term positive divergence between those two lows, and those two lows is a positive divergence, and we're still working our way higher. So there's a couple of elements that are pointing to higher prices, or maybe at the minimum, I'd say a pause or a halt of the decline. Let's take a look at the daily chart for that matter. It gives us a little bit more granularity. Here is that trend line that we saw on that weekly, and you can see that we bumped on that double support level last week. And this is today's price action. This is only Monday, but we jumped higher, so we already gave ourselves a little bit of a cushion, so that we have a little bit of leeway to maneuver this week. Short-term resistance, this little, I don't know, call it a double top, probably not. This one is much lower, but we broke the previous low, so there is new resistance now around 405 on the daily that we need to take into account if we're shorter term trading. But as you saw on that longer term picture, that structure gives enough elements that point to potentially higher prices. And this daily chart is sort of confirming that indeed we are in a support area and there is support below it. So that's for SPY, looking good going into the month of March. Let's move to the seasonal pattern for the sectors, and I'm going to put that RRG here to the right, and I'm going to highlight the tails that are interesting enough from a seasonal point of view. So that was discretionary, that was healthcare, utilities, and real estate. And just to remind you, we had real estate on average outperforming the S&P 500 70% of the time. Look at this tail. We had utilities outperforming the S&P 500 75% of the time. Look at that tail. And then we have consumer discretionary outperforming the S&P 500 60% of the time. And we had healthcare outperforming the S&P 40% of the time, meaning underperforming the S&P 60% of the time. Let's start with real estate. And I've got the chart here on the right. Now, this constellation, a tail on the weekly that is bending downward while inside improving, which means that it's not strong enough, the momentum wasn't strong enough to pull that sector all the way to the right into the leading quadrant. That's a sign of weakness. It's a sign of relative weakness, not of relative strength, as the seasonal pattern indicates. And if I look at the price chart, then we can see that we are coming down from a test of falling resistance. This rising support line is now under pressure. We're testing it. But what's really not good, in my view, is the fact that that RS line is breaking below that freshly building support. It's already rolling over, and you can see that's reflecting in the RRG lines, starting to the tail for XLRE to roll over a while and improving. So I'm not gonna go along with the 70% of the time outperformance. I don't think that's gonna happen this year. The structure, the price structure, the relative structure is simply not strong enough. It's not aligning with that outlook. So it's definitely not a buy. But what does it mean? I mean, this could mean, I was thinking about it, preparing for the show. How can I interpret this? What should I do with this kind of opposite information from seasonal and actual? And I came up with the idea that maybe, I mean, this tail for real estate and this chart is actually not looking too good. The fact that the seasonals are strong could mean that we're going to see a pause or a halt in that decline. So where you maybe normally would expect a more rapid decline, the seasonals are going to protect this sector from falling really fast and really hard based on the historical seasonal pattern. And a similar thing happens with utilities. If you look at the utility still, that's probably the weakest, well, maybe together with healthcare, the weakest tails in this group of four. And if we look at utilities here, then you can see why that is. That it's a little bit further ahead of real estate. We tested resistance, we completed a double top pattern, and we're on our way, I think, to support around 64. Here also, relative strength has broken below support, and the RRG lines are already both below 100. This whole constellation, that tail pointing downward, that break here, is leading to the belief that we will see quite aggressive relative, but maybe also price downside for the utility sector. The strong seasonal could stop that, could pause that decline. So it's definitely not a buy for me, whatever the seasonals are telling. But I wouldn't, if you're into shorting stuff, I wouldn't short this aggressively because the seasonals are pointing otherwise. I hope that I make sense with what I'm saying. So we got two contradicting signals, and then usually it's probably a good idea to just stay away or keep your positions really, really small for this. The third sector here is healthcare. That's a different story. That is pushing into the lagging quadrant right now. That last segment of that RRG is based on today's price action of Monday, the 27th of February. So there's still a week to go, but the direction is clear. And this is probably gives you better opportunities, especially when you look at the price chart where we just broke below support, and there's quite a bit of downside to the next support area, which comes in between 117.5, 122.5. But look at that broken trend line here on the relative strength line and those RRG lines pointing lower. So the combination of weak rotation on the RRG, weak expectation based on the seasonal pattern, and a weak price chart which has just broken support is leading to the belief that the healthcare sector is going to underperform the S&P 500 in coming month. And then finally we have the consumer discretionary sector, and if we look at that, and then the tail here, that is insight improving at a strong heading, relatively high JDKRS momentum levels, and 60% of the time in the past 20 years, consumer discretionary outperformed the S&P 500 in the month of March. Now, this chart here shows a break and an initial rally, and it's now just like the S&P 500, although the structure, the support, the rising support line is not here where we saw that in the S&P 500, but it's definitely testing the former resistance line as support, and it has quite a bit of room to put in the first higher low. What we see here is that the RS line has managed to break back above its former support level at acted as a bit of resistance, still holding up there. That's a good sign. And the RRG lines are pointing higher, causing that tail on the RRG itself to move at a strong heading. So all in all, that combination, strong seasonal, strong rotation, and a break in the price chart, make the consumer discretionary sector a good opportunity for the month of March. So out of the 4 sectors with seasonal figures that are interesting enough, I think that consumer discretionary on the upside and consumer and healthcare on the downside are probably most worth watching. And overall, the S&P 500, from a seasonal point of view and the price structure, seems to be in good shape for the month of March. Ladies and gentlemen, this wraps up the show for this week. Thank you for watching, and I hope you enjoyed the show. Please remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern on StockCharts television. You can catch the replays and watch previous shows on the StockCharts YouTube channel or any of the on-demand channels. If you would like to engage in a conversation, you can do that in the comments under every video on YouTube or in the Discuss section on the RRG blog. Alternatively, find @RRG Research on Twitter, Facebook or LinkedIn, or simply shoot me an email. I'm looking forward to seeing you again next week for a new episode of Sector Spotlight, same time, same place.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.